Hello, everyone, and welcome to the How to Profit from Pullbacks and Short-Term Price Swings Trading Workshop. I want to first thank each and every one of you for taking your valuable time out of your busy schedule to join us today. Now, I see lots of familiar names from literally all over the world here, and I'm really glad to see all of you. I think it's in part because of the very special guest I have on today, Roger. And the anticipation is really high. At least I know that to be true with all the calls and the emails that I've been getting over the last few days. As you know, my name's Todd Mitchell, and I'm the founder of Trading Concepts. And again, I want to welcome all of you here today. We filled up so quickly for this workshop that I wish there was a way to get more than 1,000 people here with us. But unfortunately, technology speaking, we're just not there yet. Now, before I start, I want to make sure that everyone can hear me well. So if you can hear me, please send me just a quick note using the box below. Let me see. All right, Scott, Jason. Okay, good. Okay, good. So I'm seeing that there's no problems here, no microphone problems. I'm assuming it sounds all right. Type in something to let me know that it sounds fine. All right, Jill. Oh, all right, Pat from New Zealand. Okay, thank you. Okay, sounds good then. Also, before I forget, I want to go through the mandated government disclaimer and to summarize it for you. It basically tells you very common sense things like don't trade with money that you can't afford to lose and only use risk capital when you're swing trading stocks or any other type of assets such as futures, currencies, ETFs, or option contracts. All right. In addition, if you use margin, you can lose more than what you originally started with because margin is leverage. So please take this into consideration. Also, it's very difficult psychologically to make money when you're trading with money that you can't afford to lose. So please avoid doing that. You should paper trade when you're first learning any new type of trading method and then just build up your position size slowly, starting with very small share size or contract sizes if possible, okay? Now, all right. Now that we've got all of that out of the way, it's now time to introduce you to a man that I not only respect and admire as a super successful trader and has taught me a whole lot, but I'm happy to call him a good friend of mine. And I know most, if not all of you, are here to hear him because until now he's been kind of behind the scenes and all you've really seen is his picture. As you already know, his name is Roger. And without further ado, I'm going to hand the mic over to him. Roger, are you there?
Yes, I am, and thanks, Todd. I really appreciate the introduction, and I'm really excited and happy to be here with you and your group today. I prepared some of my favorite actionable trading tactics that you'll be able to apply to your trading after watching and participating in today's class. So let's get started right away. The first thing that I'm going to do is show you some great methods to screen stocks and ETFs so that you can create your own weekly hit list of volatile stocks that are prone to oversized moves and increase in momentum. I'm also going to show you two methods that are available to you to manage trades and place stop-loss orders strategically, taking into account price action as well as volatility, so that you can stay in the trade that's moving quickly and building up momentum and cut the trade once it starts to trade against the trend. I'm going to go over profit factor and explain why it's one of the most important metrics to measure your bottom line, as well as give you a scenario using profit factor. So as you can imagine, I have lots of info to share with you today, and I want to make sure you get the most out of today's session. But before I begin, I want to spend a few minutes telling you a little bit about myself and my trading background. I promise I will keep this part as short as possible. I started trading just a few short months before starting law school, a little over 20 years ago. I never practiced law, but I have to admit it does help me understand those Law and Order episodes that I watch nightly. And earning a law degree did help me develop stronger analytical skills. But other than that, I've never practiced law since I graduated about 17 years ago. I figured that if trading didn't work out, I could always go back to practicing law. But after professional trading, and managing multiple hedge funds for close to 2 decades, I doubt that being a lawyer is going to be in the cards anytime soon. Personally, I've been married for over 13 years now and have 3 wonderful kids who enjoy spending time with me, but I'm counting down the clock, and each day as they get older, I get less and less popular. I guess that's what teenage years are all about. I spend most of my free time with my family, and we enjoy outdoor activities on the weekends, which is the only time I get away from trading. Professionally, a short time after I finished law school, I got a job as a broker. And a few short years later, I had my own brokerage firm, as well as 2 multi-million-dollar hedge funds. I was very happy with my business success, but my family was growing, and I was getting very tired of working almost around the clock and not being able to spend more time with my family. So one day, I was approached by a few business associates who asked me if I wanted to get involved in sharing my professional trading experience with other traders. And this was the opportunity I was looking for. When we first started out, I used to do live seminar events and travel all the time. But now, because of the internet, I can teach thousands of traders in a virtual environment at any time from any location. And that's very desirable for me because I don't have to travel and sit in airports half the time. And lastly, I want to let you know that if you want to get the most out of this workshop, I highly encourage you to participate as much as possible. Since we have 1,000 people here today, I cannot answer everyone's question online. But I promise that I will answer each and every one of your questions before the end of the day today. And Harry from St. George is asking if this is an advanced workshop or a beginner's workshop. And Harry, I make the assumption that you know very basic terminology and have very basic understanding of investing. And this is one of the reasons why I want everyone to ask questions. Because if you have a question, then others have the same question. And you should all know that your question provides me the basis of knowing exactly what I should be teaching you. So I encourage all of you to ask as many questions as possible, and I'll try my best to answer them for you. I hope that makes sense, Harry, and I want to thank you for being here today. This workshop is structured a bit differently than what I typically do. I decided to take some of the most frequently asked questions and find those that have a common thread and create a workshop around those questions. This way, your most frequent questions can get answered, and at the same time, I expand on them to give you even more feedback. So first, and one of the most frequent questions I get is from traders who want to know how to create their own hit list or their own list of stocks to watch every week. And this is a great question because traders who create a systematic hit list or a list of stocks or other assets that they follow actively have specific criteria. And this criteria has to include and leverage the qualities that your trading methodology requires the most. Let me expand a bit so you can understand where I'm coming from. The hit list you create depends entirely on your specific trading style, time frame, and risk. A list that works for a swing trader who trades breakouts, for example, would be completely different than a swing trader who trades pullbacks. So when you create a hit list, you have to first figure out what you're trying to achieve, your time frame, and your risk considerations. With that said, I'm going to show you some of the 3 of the best places to look for your list criteria. And I'm going to share with you some of the filters that I use to make my own weekly hit list as well. The first site that I like to visit is called FinViz. And what you need to do once you're there is to head over to the screener button on the main menu. Once you're there, head over to the button slightly below to the right that says Technical. When you get there, you will see a list of stocks in alphabetical order. And going horizontally is a list of some of the most popular and useful technical analysis filters. For example, you can see the ATR, 50-day moving average, 52-week high and low, and several other indicators that you can quickly use to see if any of the stocks on the list fit your criteria for a specific setup. I find this to be a very useful screening tool and one that allows me to screen hundreds of stocks very quickly, especially if I know exactly what criteria I'm looking for. So let's say I wanted to quickly find a stock that was priced over $100, that has a very high daily volume, and ATR over $2 or higher, for example. I could easily scan the first page and find that Apple stock fits my criteria, and I could do this very quickly. The three particular filters that I often use is the 52-week high, ATR, and the price filter. So for example, if I want to find stocks that are getting ready for breakouts, I would look for stocks that are priced over $50 because they tend to move quickly. I would also like to see the price of the stock to be within a few percentage points of reaching a new 52-week high price. And lastly, I would want to make sure that the daily trading range is over $2. So this tool quickly helps me create a list because I'm able to see all the filters at the same time. This allows me to easily analyze the screen similarly to how I would be using a spreadsheet and go through a very large list very quickly with very little effort. And we have a question from Carl in Laguna Beach, who wants to know why I start with stocks that are priced that high instead of looking at cheaper price stocks. Carl, first, let me thank you for joining us today. And second, let me answer your question. I actually don't start off at $50 per share, but I do start at $40 for the most part, which is considered a higher price stock. And the reason why I do this is because I find that higher price stocks tend to have volatility and trading range for the most part. While you can find a $20 stock that moves over $2 per day, which is what I typically would look for in a swing trading stock, it's not that common compared to a $40 stock. So I stick to higher price stocks because I want my trading range to be on the higher side. If you're looking for momentum stocks that you plan to hold for some time, then you can go as low as $15 per share. But for swings that last a few days, I stick to the more expensive stocks. You can trade options with some of these strategies, Carl, and then you can avoid this problem completely. So there are alternatives for traders who don't have a large account and cannot afford to trade expensive stocks. I hope I was able to answer your question, Carl, and thank you once again. The second function that I find extremely useful when using FinViz is the groups function, which you can find back at the top menu. This feature allows you to quickly see strength and weakness in a specific sector as well as industry groups. And it gives you the data based on various time frames ranging from daily to yearly. So if you only want to focus on sectors that are very strong compared to the rest of the market, the group function will tell you exactly which sector or which industries are gaining and which ones are losing the most. I find this very useful when taking directional trades, and always try to go long when the stock or ETF is stronger than the rest of the stock market, or sell stocks that are much weaker than the broad market. So after I gather a large list of stocks that are near 52-week highs and 52-week lows from the screener, I tend to see which of the stocks fit into which industry groups, and that helps me gain a substantial advantage because I'm buying very strong stocks and selling very weak stocks. The second site I like to use for filtering and creating my weekly hit list is barchart.com. And I mentioned this site before many times. Once you navigate to the home page, you simply hit the stock button and navigate all the way down to the left-hand side of the page. You will see a section called More Stocks, and below that is a button that says Sectors. And once you go to the sectors page, you can scroll down a bit and you will see various choices such as industry groups. And once you click that link, you will see a list of all the different sectors and the strength and weakness in those sectors. And here is how I use this function to help me with my hit list. I can click on any of the sectors and bar chart will give me the names of the stocks in these sectors. So this is very useful and can save you a bunch of time trying to figure out which stocks are in each sector. In this example, I clicked on the gold mining sector, and you can see a list of all the components in that group. So using bar chart and FinViz, I can create a very strong list of stocks that have strong momentum and volatility. And Benjamin from New England wants to know if sector strength and weakness can help when you're using a very short time frame. And that's a very good question, Benjamin. And I'm sure others have a similar question. So I want to thank you for bringing this up. And to answer your question, yes, even though we're holding sometimes for a few days, I find that when you're using sector strength and weakness, surprises tend to happen in the direction of the main trend. Or in this case, if you're in a super strong sector, you can find yourself with positive news coming out for days on end. And when you sell the weakest sector, many times we will have very strong surprises to the downside in that sector. And since we never know what will happen, it's best to always put yourself in the position of being on the same side as the news that's coming out. In addition, I find that stocks that are much stronger than the stock market tend to pull back less, and stocks that are weaker than the stock market tend to gravitate to the downside every chance they get. So over the years, I found that using this method or adding this method to your screening process decreases the average risk on the trade, and that's huge in my book. In addition, when you click on the Stocks tab, there's a section called Performance, and you can filter stocks based on how well they outperformed other stocks over different periods of time. And this is a great way to find stocks that are gaining momentum very quickly, as well as losing momentum. So for example, if you want to only trade stocks that gained 2,000% over the last several years, this list will give you those stocks. And one way to utilize this list is to watch these stocks carefully for pullbacks. Because if a stock outperformed all other stocks over the last 3 years, for example, the odds are higher that it will continue to gain momentum over time. And these stocks are very good candidates to use different pullback techniques. I was looking at the 10-year leaders just a few days ago, and I saw many familiar names such as Priceline, Monster Beverage, Netflix. They're all on this list. And Gabriel from Vermont wants to know which list is best for short-term pullbacks. And Gabriel, I would focus on 9 months and 12-month leaders to get a good list of stocks that are just starting to gain momentum and outperform the market. The 10-year example I just gave you was just to show you what's possible and what's available. But I would stick to 9-month and 12-month lists for actual short-term trading. I hope I was able to clarify that for you, Gabriel, and thank you for your question and for participating today in this workshop. And Jerry from Brooklyn wants to know how often these figures are updated. They're updated at the end of the trading day and sometimes throughout the day. But you don't have to look at these indicators every 5 minutes. I tend to build my weekly hit list on weekends. So I do most of my research while the markets are closed. So having these indicators update more or less frequently won't really help you too much if you're swing trading. I hope that answers your question, Jerry, and I want to thank you for participating and being here today with us. Okay, so moving right along, I showed you 2 sites, and these are the sites that I use for very general type of filtering. Basically, I use bar chart and FinViz to help me figure out which sectors I want to buy, which sectors I want to sell, and which sectors I want to avoid. In addition, I can quickly make up a list that's based on trading range, volatility, momentum, and specific price levels. So these 2 sites allow me to cast a wide net and quickly collect a good overall list for future filtering. But sometimes I want to zero in on a particular price pattern, or I want to see a stock that's setting up for a particular setup. And this is when I rely on StockFetcher. And I've been using this company for several years now. And before I go further, I want you to know that I don't work for them. I don't get any kickbacks. I'm not an affiliate in any way. So this company offers a paid service, which to the best of my knowledge is, I believe it's $8 per month. And there's free services as well. Now, I subscribe to their service and I think it's worth every penny simply because it's so fast and saves me so much time. But there are several free services as well that you can use to generate some great setups. For example, if you head over to their homepage and click on the second button, which is the examples button, you will notice all the different custom scans that they already have preset on that page. Some of my favorite presets include the 4-day consecutive loss. This will automatically give you all the different stocks that are closing lower than they opened over the last 4 days. And when stocks are closing below their open for a few days in a row, it usually means that momentum is beginning to slow down. And I often combine this scan with the output that I get from bar chart that I just described to you a minute ago, the one that gives you a list of all the stocks that are outperforming the market for the extended period of time. So, for example, if I get the same stock on both lists, I know that one of the strongest stocks in the entire stock universe may be primed for a very short-term pullback as a result of the slowdown in the momentum that we're seeing. Another one of my favorite scans is called ATR increasing, which is a bit lower on the same page. This will give you a list of stocks that have the average daily volatility range increasing over a specified time period that you get to pick. So say I want to create a list of stocks that are gaining volatility because I want to consider an option selling strategy. Well, this list will give you some stocks that doubled in volatility over the last several days. And that's one list you want to have if you want to find very overvalued options very quickly. One other filter in StockFetcher that I use frequently is the RSI threshold crossover. This handy tool lets me know if one of the stocks that I'm currently looking at is coming out of oversold territory, or similarly, if the stock is beginning to come out of overbought territory. Most of you know that I don't like to use overbought and oversold setups because stocks tend to stick around the overbought or oversold level for a long period of time and don't turn around right away. So you end up having to stay in the position for a long time. So instead of getting into a reversal, you get into a trading range, and that can last for several months. And that's not the ideal here. So instead of watching the stock when it moves into the overbought or oversold territory, I can use this tool to let me know when the stock is ready to move outside of the oversold or overbought levels. And this is what I really want to know. Too many traders focus on finding stocks when they're inside these levels. Well, the problem with that is they can stay there for a long time. I only focus on stocks that are ready to move outside of these levels. In this example, ABX stock entered the oversold area on September 18th and only crossed above the 30-day RSI on October 8th. So all that time you would have to wait for the stock to stay in a very deep oversold level. And I don't like to wait that long when I'm swing trading, especially for stocks that do very little. But if you entered on the 8th of October, you would enter the position right at the time when the stock is moving back and away from the oversold territory. And Kent from Atlanta says, I'm getting more out of this than most paid workshops. Thank you for that, Kent. I try to give as much actionable trading info as possible. And you can apply these filters the same way I use in my trading. Peter from Alberta wants to know if you can use these methods to enter options trades. Yes, Peter, you can do that with options, but options have other factors you have to consider. I think you're thinking that because the stock is overbought or oversold, the option must be as well. The problem with this theory is we don't know how long the stock's been in the oversold or overbought area. For all we know, the stock could have been there for several weeks. So what was once an oversold or overbought level is now a common trading range. And most traders got used to the price being at this level. So once the price is not out of character for a few weeks, then the option won't be as overvalued or undervalued as you may expect. I hope that answered your question, Peter. The ATR indicator I explained earlier is a better alternative, in my opinion, for finding overvalued options quickly. So before we move ahead, let's review some of what I covered so far. I explained the 3 different sites that you can use to create your weekly hit list of stocks and ETFs that you're going to focus on for the upcoming week. I also showed you a few of my favorite scans that help me find stocks and ETFs that are setting up for different types of setups and different types of market cycles. I specifically showed you how you can use sector strength and weakness to increase your profit potential and decrease your overall risk. I also demonstrated how I use the increasing ATR filter 4-day as well as the RSI filter to help me find stocks that are extremely overvalued based on volatility or coming out of very sold or overbought levels. And Michael from Oklahoma wants to know if I prefer stocks or ETFs. Michael, thank you for participating today. And to answer your question, you should know that it completely depends on what's going on in the markets. If there's going to be events occurring that may cause strong impact on the overall market, such as the Fed speaking, then I will trade individual stocks. But if the market is trading purely on technicals, then I will consider indexes and ETFs. So it really depends on what the current landscape appears to look like. I hope that answers your question, Michael. Okay, so the next topic I want to cover, and one I've been receiving tons of emails about, is what strategies to utilize to trail your stop loss orders and take profits to maximize your profit potential on the trade. And you should know that trailing stop questions are tricky because it's always a battle between giving your stock or whatever market you're trading room to breathe and move around, but at the same time, you need to be able to tell the difference between a random move that's simply part of market noise and a real move against your position. So it's always a fine line between protection and risk. And I'm going to show you some stop loss methods that take market action into account. And that's what's really important here. One of the methods that I'm going to show you for trailing your stop loss orders is a method that uses the moving average indicator. And before I move on, I just want to add that this method works very well if you're trading quick moving markets or stocks that are moving very fast. So getting back on track, most traders use the moving average to help them enter the market. But the moving average is a great indicator to help you place your stop loss orders. And the great thing about using the moving average is the fact that it moves along with price. So if the stock continues to gain value, the moving average will dynamically adjust and lock in profit. I use an exponential moving average when I'm trying to use the moving average for risk instead of entries. The exponential moving average is more dynamic with market price and works well with swing trading time frame. I use a 20-day time period, and if I'm in a strong move, I find that the moving average will do a great job of keeping me in winning trades for a substantially longer period of time if the trade is moving in the right direction. So in a nutshell, it gives you a good balance between risk and reward. You can see in this example a 20-day exponential moving average trailing this breakout move to the upside. As long as Apple remains reasonably steady, the moving average will not interfere with the position, and the trader will be able to squeeze out every cent from this trade. This is actually a good example because the moving average kept you in a winning trade for about 2 months while Apple was rising steadily. Here's another example, and you can see how Google stock breaks out and the 20-day average keeps you in the trade for over 3 months. So you get an exit stop and a trailing stop in the same indicator, and I can promise you that most traders would get out of this profitable trade a lot sooner than when using this indicator. And it's nice having these major winners, so keep this indicator in mind for momentum moves. And David from Minnesota wants to know why we use an exponential moving average instead of the normal moving average in this case. And this is a great question, David, and I want to thank you for being here today and for participating as well. And to answer your question, David, the exponential moving average puts more weight on price data that's closer to today's date and less weight on what happened 20 days ago, while traditional moving average puts equal weight on each day of the average. So the regular moving average is a great indicator to use as a general market filter to see if the market is trading above or below the 90-day average, for example, is used to determine if the overall market is bullish, if the market is trading above the average, or conversely, if the market is trading below the 90-day average, the market is bearish. However, the exponential moving average is much more responsive and will give you much more reaction compared to the simple moving average. And because we're using a very short time frame, we need a reaction between price and the indicator to be timely, at least much more timely and responsive than using a regular moving average. And I hope that answered your question, David. Keep in mind that I use the 20-day EMA for trailing my stop loss only when I trade breakouts or momentum trades. The 20-day EMA lends itself to these type of trades because momentum trades move quicker than most other type of setups. So I want to use a very dynamic indicator that moves very quickly, along with price of the stock that I'm holding. So if the position is holding strong, the moving average will continue holding the position. And if the market begins to lose momentum, the trade will be cut off fairly quickly. And Lewis from Connecticut is asking why I use the 20-day exponential moving average instead of a shorter time frame or longer time frame. And Lewis, the reason why I use the 20-day exponential moving average is because I back tested over the years several different time frames. And the best compromise between managing risk and letting profits run is anywhere from 18 days to 23 days. Once you start increasing the time beyond 23 days, the risk becomes a bit on the high side. And when you move below 18 days, the profit is cut off a bit short, and it doesn't do much for your risk as well. So after 16 years of backtesting, I found that the 20-day time frame to be a reasonable trade-off between risk and reward. And I hope that answers your question, Lewis. And I want to thank you for attending and participating today. This was a great question, Lewis. And remember, if I don't get to your question, it's only because we have over 100 questions at this time that I have to answer. And John, my assistant, is giving me the questions as they're coming in. So I promise I will get to your questions before the end of today. Moving on, I want to show you one additional technique that I use to manage my trades. And this particular method was created over 40 years ago and used by some of the largest hedge fund managers to trail their winners and cut their losers. And what I like about this particular method is how the market completely dictates when you should stay in the trade and when you should liquidate your position. The method is called the 10 by 10, and I'm going to show you exactly how it sets up and a few examples so that you can get a really good feel for this method. I demonstrated the 10 by 10 method before in one of the videos I made a while back, but I received many questions, so I will go over it a few times so that you can really understand it well. Keep in mind that the 10 by 10 method is not an entry method. It comes into play after you enter a position and build up a bit of profit in the trade. So instead of raising your stop loss to the break-even level on the trade, you would apply this method instead. And remember, you can apply this method to any type of entry, regardless if the trade originated from a pullback, a breakout, or any other type of method that you're using for swing trading. So let's say that you entered a long trade in Amgen stock on a breakout. And notice where I placed the original stop loss, right at the 10-day low. Instead of moving your stop to break even, you would instead figure out the lowest price the stock traded at during the last 10 trading days at any given time, and place your stop loss there as the stock moves higher. And you would continue trailing your stop higher and always slightly below the lowest traded price during the last 10 trading days. In this case, and this is a really good example by the way, the stock continued moving higher and never traded below its 10-day low price till the first week in October. Notice how the stock itself dictates when it's time to get out. That's the great thing about this technique. And if the stock stayed strong and the momentum kept moving, this simple filter would have kept you in the trade a bit longer. So it's a great way to stay in the market and let the market decide when it's time to get out. So let's take a look at another example, an example of Morgan Stanley stock. The entry method that was used here was a proprietary pullback method that I used. But the entry method is completely irrelevant here. Notice how the price is trailed and the stop loss moves higher. But as long as the stock continues moving higher, the 10 by 10 exit will keep you in the trade for a very long time. And as soon as the stock begins to slow down and lose momentum and hit a 10-day trading low, this method would get you out of the trade. Eric from New York wants to let me know that he's learning tons from this workshop. I'm glad to hear that, Eric, and thank you for the nice words. I really do appreciate it. We have a question from Martin, who's in New Mexico. And Martin wants to know if the 10 by 10 method can be used for pullbacks or breakout methods. And to answer your question, Martin, this method works very well with both pullbacks and breakouts, as long as the market you're trading has sufficient volatility and momentum behind it. Also, Martin, this method works best when your time frame is beyond very short-term trading. So if you intend to hold a position for a few weeks or maybe even a month, then this method may be a perfect fit for you. But for trading methods that only hold positions for a few days, I recommend using a fixed dollar stop or other types of very short-term profit targets. And I hope I was able to answer your question, Martin. And thank you so much for participating in the workshop today. I really do appreciate it very much. And before I forget, you don't have to track the 10 by 10 method manually. You can easily set up a filter in StockFetcher. You can set up a custom filter so that when your stock hits a 10-day low, you will know right away when this happens. So you don't have to calculate it manually if you don't want to, or if you don't have the time to do so. This is an example of an ETF that tracks the Dow Jones. Notice when the Dow was moving higher, the 10-day low was tracking fairly far behind. And as the Dow started losing momentum, the 10-day low started hitting the price action almost daily. This is a good example of the 10 by 10 doing exactly what it's supposed to do: keep you in momentum moves and out of range-bound moves. Let me give you another example. In this case, I'm using one of my favorite ETFs, the semiconductor index. So I entered this trade at 49.40 price level, and I placed my stop loss at the 10-day low, which happens to be 47.90. So the stock begins to gain momentum, and what looks like a potential exit as the stock begins to go down and makes a 4-day low, but it pulls back up and gains momentum once again. If I relied on my judgment, I probably would have exited this trade much sooner, most likely where the stock made the 4-day low instead. But the 10 by 10 kept me in the trade, and once the market decided to slow down, I simply followed the trading action. This way, I'm not imposing my will on the market, which is the best way to trade consistently and profitably. The downside of using the 10 by 10 method is that you're going to have a higher percentage of losing trades because you're not locking in your profit at the break-even level. but the upside of extending your profit substantially strongly outweighs having a higher percentage of losing trades. To give you some numbers behind this, I backtested 400 trades using a trailing stop loss that brought the risk stop to break even and compared it to using the 10 by 10 method of exits. And the results were drastically different. Using traditional stop loss methods, my profitability was 61% and my profit factor was 1.8. When using the 10 by 10 method, the percentage of profitability decreased to 54%, but the profit factor was 2.7, which is substantially higher. And increasing the profit to loss by such a large margin outweighs having a higher percentage of losing trades. And as a result, the 10 by 10 comes out a clear winner. And we have a question from Sam, who's in Long Beach. And Sam wants to know what type of method I was using and how long I was holding the trades. Sam, these are great questions, and I want to thank you for being here. I appreciate you participating as well. So getting back to your question, Sam, I was using a channel breakout method that waited for the stock to stay in a trading range for about 90 days before breaking out. Any breakout that would occur before the 90-day incubation period was over would not be taken. And any stock that stayed in the channel for a minimum of 90 days before the breakout would be taken. It was a very simple strategy that I used a few years ago. The average holding period was 9 days for losing trades and 28 days for winning trades. So it wasn't an ultra short-term strategy, but not one that holds trades for a very long time either. Overall, it was a good method to test the 10 by 10 strategy compared to traditional stop loss methods that trail stop losses to break even. And I hope that helps you get a better idea. And I'm glad I was able to answer your question, Sam. Bill from Iowa says, thank you for such a great method. I'm going to apply it right away. Bill, first of all, thank you very much for that. I do appreciate it. And I want to let you know that the 10 by 10 method is very solid. And many pro traders and fund managers rely on this method day in and day out. I've used this method for over a decade now, and it works as well today as it did when I first learned about it and started using it. Okay, before I move forward, I want to quickly review what I covered so far. We actually covered quite a lot of material, so before I move ahead, I want to make sure we're all on the same page. I started off explaining the different sites I use and the different filters that I use to create a weekly hit list for my trades. I went over some of the filters that help me select sectors, and I showed you how to quickly figure out if the sector or industry group is strong or weak. I then showed you how to drill this down further and how to find the specific stocks that are in each industry group by using bar chart sector filter. So for general filtering, both FinFizz and bar chart work very well and can quickly help you generate a list of high quality stocks and ETFs. And then I showed you how I use Stock Fetcher and some very specific filters that I use, such as RSI coming out of overbought territory as well as ATR increasing, which is great for option traders who are looking for overvalued stocks. And I also showed you one other indicator that tells you all the different stocks and ETFs that sold off 4 days in a row, which is very useful for finding stocks that are losing momentum quickly. We then switched gears and I talked about trailing stops and whether you should trail your stop loss or use fixed stop loss orders. And then I showed you two different methods, the 20-day exponential moving average method as well as the 10 by 10 method. These are dynamic exit methods that follow the trade and adapt to actual market conditions. So if the stock is moving strongly without much pause, the method will keep you in the trade much longer than if the stock is struggling to maintain momentum. These methods are used by some of the largest money managers and fund traders in the world, And although they're very simple to utilize, they can drastically improve your trading performance if used correctly and in the correct time frame, which is very important for both of these dynamic management strategies. And Tom from New Orleans says he's learning very useful trading info here, and I'm glad to hear that, Tom. I want to make sure you get some value out of this workshop today. And Josh from Palm Springs wants to know, what is the best time frame for these two exit methods? And Josh, thank you for participating today and for attending this workshop. And to answer your question, I recommend these exit methods when your holding time frame is more than 10 days. If you're holding for a very short time, then you're not going to get enough value out of using these two strategies, because they do their best work when the market has more room to move. This is where the profit comes from. But when your time frame is limited to 2 weeks or less, the market does not provide enough profit to lock in and raise your stop loss. There just isn't enough profit to work with. But when you start expanding your time frame beyond that level, you can really gain substantial value by using these methods, because they will keep you in the trade as long as momentum is moving your way. And I hope I was able to answer your question, Josh. So moving on, I want to talk a little bit about profit factor, because it comes up all the time and I want to clarify it for traders who are having difficulty with the concept. I received many emails over the last several weeks asking for some clarification, so I thought I would give you an example so you can really understand the concept well. Profit factor is the overall summary or the final figure of how your method performs over time. This figure is the first and the last figures that most professional traders look at when deciding to use a particular strategy. And I will explain why you have to pay attention to profit factor and why it's so important to know what your profit factor is. In a nutshell, profit factor is simply your average loss divided into your average profit. So as long as you know both numbers, you can easily figure out your profit factor. So for example, a trader has a method, and the method is accurate 50% of the time, but his average profit per trade is about $1,400, while his average loser is about $750. So over the long run, the trader does very well and has a profit factor of 2. This means that on average, when you divide the average loss into the average winner, you get a profit factor of 2. Notice the trader was only right or accurate 50% of the time, and most beginners think that's bad. But it's not the accuracy of the method, it's the overall profit factor the method achieved that's important. And as traders gain more experience and confidence in their trading, they began to shift more and more away from accuracy and more on the profit factor. And we have a question from Daniel, who's in Philadelphia. And thank you for participating today, Daniel. I really appreciate that. And Daniel wants to know what to do to achieve the highest profit factor. And Daniel, to reach the highest profit factor from swing trading, you need to have consistent setups that have very inherent low risk and expose you to high profit opportunities. And actually, this is what I'm going to talk to you about next. From many years of trading, the highest profit factor trades that I'm able to achieve have been trades that originate at the point when the main trend of the stock intersects with the short-term trend. You can see in this example exactly what I'm talking about. Notice how QQQ ETF has a long-term trend that's moving higher and a short-term trend that's moving against the trend. I marked up these areas so you can see those points in this chart. These areas where the main trend and the short-term trend connect are strategically known as short-term turning points. And this is the lowest risk entry opportunities for swing traders. The problem is that these turning points are not easy to isolate when applying technical indicators, because most indicators are not fast enough or accurate enough to catch these short-term entry points with a great deal of accuracy. Because these setups are relatively short-term, by the time indicators give you a buy signal, the stock already moved up a few dollars. So I found that for trading these types of short-term pullbacks, where the main trend connects to the short-term trend, the best way to go is to use market price, because there's no faster indicator than market price. So several years ago, I decided to create my own strategies for effectively trading short-term pullbacks. And after a few months of testing, I found a few methods that work tremendously well, and I've utilized these methods for trading pullbacks for well over a decade now. The strategies rely on very simple setups that you don't need any special indicators to use. So you don't have to learn difficult analysis methods, and you don't have to download complex indicators on your computer. It's really very simple, and it works very well. The strategies are called the gravity pullback and V-bounce volume spike, and I specifically created these methods to take advantage of the same type of pullbacks that I explained in detail a short while back. The kind of pullbacks that take advantage of short-term setups, where the profit potential is several times greater than the risk per trade. With these setups, you'll know very quickly after you enter the trade whether the trade is going to go your way or not. The great part about these strategies is the fact that the stop loss levels, or the risk levels, are extremely small in comparison to the profit potential per trade. And you can use options with these methods instead of stocks because you're entering on a pullback or a price retracement instead of a breakout, which is very important if you want to trade options. I always tell my students to avoid buying options when stocks are breaking out because the volatility is increasing and the option is more than likely overpriced. But when you're trading pullbacks, the stock is pausing and losing momentum temporarily. And most of you know that when stocks or other assets are slowing down, volatility is reduced substantially compared to when the stock breaks out. So it's a great time to buy an option, and that makes the gravity that much more attractive. But whether or not you trade options, volatility is reduced on pullbacks. So your risk per trade is going to be inherently lower than when you're trading breakouts. And that alone gives you a substantial edge in your trading. Blake from Oregon wants to know, how long does the gravity hold trades? And Blake, I want to thank you for being here today. I've been to Oregon and it's a beautiful place. And Blake, the average is a few weeks, so you get a good trade-off and not too much of a holding time. There are times when the gravity can hold trades for just a few days, and sometimes the trades are held beyond 3 weeks. But a few weeks for profitable trades and shorter time frame for losing trades. I hope I was able to answer your question, Blake. And let me tell you a bit more about the gravity strategy, Blake. I don't use many different pullback methodologies because most indicators are simply not accurate and quick enough to catch short-term trend changes. But when you're relying on actual price, you can react very quickly to immediate change. The filters and the rules are very simple, and you don't need to be a programmer or know any advanced math to be able to figure out exactly where to place your entry and your protective stop. So if 20 people were looking at a chart, they would all get the exact same price level for their entries, as well as their exit orders. Michelle from South Dakota wants to know how difficult or how much time it would take to learn how to use the gravity strategy. And Michelle, thank you so much for being here today. I love your name. It's my oldest daughter's name. And to answer your question, the rules are very simple and clear. Everything is spelled out and you get numerous step-by-step examples where I walk you through the strategy step by step. The gravity pullback and the V-bounce volume spike strategies will save you lots of time trying to figure out how to trade pullbacks correctly. I created very detailed video tutorials that explain the different rules and the conditions that you need to follow. The videos are very high quality and go step by step through numerous examples. And Frank from Calgary says that he wants to get started ASAP. Frank, you're going to love the video tutorials, and you're going to learn tons about trading pullbacks the right way. And Frank, you should know that these strategies are practical, and are designed for real market conditions. This is not some theory that you're going to learn and put away and never use. This is something that you can apply to the markets right away. I've seen and traded many other strategies that claim to spot pullbacks, but honestly, I've traded just about every type of pullback strategy, and some that have sold for over $3,000. And I have not been able to get any of these strategies to replicate the results I get from trading the gravity pullback and the V-bounce volume spike strategy. Not even remotely close. And remember, the gravity pullback and the V-bounce volume spike strategies do not use complex indicators. So it's very easy to get set up, and you don't have to download or learn to use advanced market timing tools. These strategies are simple and very effective, and that's what you need to know. And remember, the stock market may be getting more bearish sooner than later, and being able to swing trade pullbacks is a great way to take advantage of the current market cycle. Rudy from Kansas wants to know if a beginner can use the gravity strategy. And Rudy, you should know that I created the strategy using simple and clear to understand filters and other conditions that are easy to apply. The gravity is flexible enough so that you can trade it frequently. But at the same time, the rules of the gravity strategy make sure that you're on the right side of the market and moving in the primary direction of the trend. I hope I was able to answer your question, Rudy, but anyone with very limited technical analysis experience should be up and running very quickly with the gravity. And we have a question from Walter from Florida. And Walter wants to know if gravity uses partial profit targets. And Walter, thank you for participating today. And you should know that gravity is designed for small positions as well as large positions. So I designed two different exit methods, one for small traders and one for large traders who have bigger positions. It's up to you which method you apply, but yes, there's a system for partial profit targets as well. And you should know, and I should have mentioned this earlier, but the current stock market climate is very different than what most of you saw over the last few years. The Fed is not putting money into the bond market. So you're not going to see these long trends in stocks and in indexes. You're going to see the more typical range-bound cycle with less and less breakouts. And the gravity is a pullback strategy, and it will give you more opportunities to take advantage of the current market cycle than trading breakouts. At least while the stock market stays in this cycle, and it can stay there for a while. And we have a question from Alan from New York, who is asking if the strategy works with currencies. Yes, Alan, you can apply this method to any financial market that has volatility. As a matter of fact, I was trading an ETF the other day. ETF stands for Exchange Traded Funds, and they trade like stocks, but this ETF was following the commodities market. And I was able to use the gravity strategy to take advantage of this market. So yes, you can apply gravity to futures, currencies, and commodities. And options work very well as well, because you're buying when volatility is low, and that's what you should be doing with options, if you're the buyer and if you're taking directional trades. I have to pre-qualify that. I hope I was able to answer your question, Alan, and thank you for joining us today. And we have a question from Nancy from San Jose, California. And Nancy wants to know how big of an account you need to trade the gravity and the V-bounce volume spike strategies. And Nancy, that's a great question. And here's the thing. If you're trading stocks, you can trade anywhere from a few shares to thousands of shares. It's entirely up to you. And what's great about the gravity pullback and the V-bounce volume spike strategies is that you can also trade options using these methods. And that means many traders who have smaller size accounts can utilize these methods too. And I hope I was able to answer your question, Nancy. And thanks for participating today. All right, I think I've been going nonstop for close to an hour now, Todd. I'm going to hand the mic back to you. But I would first like to thank you for inviting me here today. I really appreciate it, and I would also like to thank all of you that took the time out of your busy schedule to attend, and for helping me put on a great workshop by asking some terrific questions. I truly hope you've enjoyed and learned a lot from what I showed you today. And if you have more questions, feel free to email me at roger@tradingconceptsinc.com. I know Todd values and appreciates every one of you, So I really hope I've been able to give you some great value here today. All right, thanks again, Todd, for inviting me. Back to you.
Oh boy, Roger, thank you. You did an absolute fantastic job. And with all the comments that were coming in while you were talking, I know everybody here felt the same way. And boy, the real nice comments keep coming in too. I think you hit it out of the park, Roger. So again, thank you again, okay? Boy, an ex-hedge fund trader that took $20 million to $740 million in less than 11 years is quite a treat to learn from. So thank you again, Roger, for sharing your insights and giving my group here some great actionable trading strategies they can start using tomorrow. Really good stuff. All right, I don't see any more questions right now. I think Roger did a great job answering those for you. But please, if you have any more, be sure to type those in the box below, and he'll be sure to type back a response for you, okay? Now, just a quick backstory on Roger and I before I wrap this workshop up. Look, I met Roger a little over 2 years ago, and he was quick to show me 2 strategies he was really proud of. The gravity and V-bounce volume spike, as he alluded to and talked about a bit earlier, okay? And it really got my attention because, as a lot of you already know, I'm a big pullback and retracement trader myself. So, suffice it to say, we really hit it off and have a lot in common. You see, when he showed me these 2 strategies, I was literally blown away at how simple and uncomplicated they were. There's no guesswork involved whatsoever, and that's what I absolutely love about these 2 strategies. And as I learned more and more and started actually trading these strategies myself with real money, I saw how they generated consistent profits from low-risk, short-term pullback opportunities. You see, the gravity and V-bounce volume spike strategies are time-tested swing trading strategies that have earned Roger and I consistent profits with low risk per trade, and that's what I absolutely love, and that's what helps us get a major advantage and significantly increases our profits by following the large hedge fund momentum. And as most of you already know, trading pullbacks truly gives us an unfair advantage over the other traders in 3 big ways, okay? First, pullback trading offers high probability entry opportunities with lower risk per trade, which helps us grow our accounts much more quickly. Second, the profit for every dollar at risk over time tends to be higher when trading pullbacks in comparison to other strategies like breakout type of strategies and trades, okay? And then the third major advantage is that pullbacks and or retracements are ideal for options traders because volatility levels decline during pullbacks, which lowers the premium you pay for the option. All right, so the gravity and V-bounce volume spike strategies are a winning combination of low risk with big profit potential. And that's what I love about them, and that's what I personally attempt to get from all the strategies that I trade, right? Which of course sometimes doesn't always work out the way you had originally planned. To learn more about the gravity and V-bounce volume spike strategies, just go to the link below here, okay? I'll also copy that link in the window here for you. All right, so this is what I've done. I spoke with Roger and I asked him if I could secure 100 copies of the gravity and V-bounce volume spike strategies for you, okay? Because each and every one of you are valued students, and I truly do appreciate each and every one of you. And I really mean that. You see, Roger only allows a certain amount of copies to be released each year. So he was nice enough to agree to 50, okay, not 100. Well, 50 is better than nothing, right? And with that being said, he also agreed to give you a massive 50% discount off the regular price, which makes this deal even better. So, thanks again, Roger. We really do appreciate that. Okay, so let's deal with the elephant in the room. How do you get in, and what's the investment to have direct access to Roger for as long as you want? Now remember, Roger isn't just some ordinary trader. He's an ex-hedge fund manager that took $20 million to $740 million. Okay, that's $750 million in less than 11 years. Quite a substantial feat, I might say. Okay, well, let me ask you a question. If all you did was take the gravity and V-bounce volume spike strategies and discovered a new, more predictable and profitable way to trade the markets, or if all you did was have direct access to Roger for as long as you want, to stay by your side and be there to answer all your questions, or if all you did was learn a new way to earn a consistent weekly and monthly income using these strategies, what would these benefits be worth to you as a trader? Now, do me a favor and please type in what this would be worth to you. Just type in the browser below you. Just type in what do you think all these benefits would be worth to you. So okay, I see a lot of people. Okay, tons of people are typing in now. In a wide range of answers. I see $500, okay, 1,000. Someone typed in thousands. Oh, one of you typed in priceless. I agree with you. All right, Jane. Okay, Scott, Terry, Bill. Okay. Zach. Oh, Zach, good to see you from Australia. Okay. Yes. I actually agree with all of you. It's really hard to put a price tag on something like this. I mean, it really is. And thank you again for all of your great feedback here. I didn't think I was going to get as much as I got here. But yes, good feedback. All right. So you'll be happy to know that if you're one of the 50 traders that gets the opportunity to have full lifetime access to use the gravity and V-bounce volume spike strategies, Roger has allowed me to cut the price 50% from $797 to only $397. So again, Roger, I'd like to say thank you for giving us that big, huge savings today. And look, Roger and I both want you to be more than thrilled with the gravity and V-bounce volume spike strategies. So we're going to go ahead and give you a no-nonsense guarantee, okay? So if you decide to get in and start using these strategies, and within the first 30 days, you place 5 trades and don't end up with a net profit, we'll refund your purchase price 100%. So again, if you don't make money during the first 30 days, you can ask for a full refund. Okay, it's really as simple as that. You risk absolutely nothing. But in my opinion, you have everything in the world to gain by giving it a try. Again, just go to the link at the bottom of this page to learn more or to get started. But hurry, Roger is only allowing 50 of you to use these strategies. All right, I still have a few minutes left, and I noticed a few questions coming up that Roger hasn't yet been able to address. He's been answering questions like crazy here, so let me take a few moments to answer them for you, okay? And again, if you have a question about the gravity and V-bounce volume spike strategies before we end this workshop, please be sure to type them in the box below. All right, George writes, what size account do I need to trade these strategies? All right, like Roger answered earlier on in the presentation, George, you can have a really small account, as little as $500, and still be able to trade these strategies. I mean, as long as you can trade a share of something, of a stock or an ETF or an option. So again, the size of the account does not matter. It doesn't matter how large or how small your account is. Any account will work. All right? Next, Patrick wants to know, okay, is there any special software that you need to have in order to use these strategies? Good question. Absolutely no. Any software will work just fine, Patrick, okay? That's one of the great things about using these strategies. You can actually use free services if you don't have TradeStation or Thinkorswim or NinjaTrader or any of the others that cost money, okay? So just like Roger mentioned earlier on in the presentation, he gave you a bunch of those services that you can use free of charge if you don't already have one, okay? Hope that answers your questions, Patrick. All right, Jim asks, what markets work best with these strategies? Okay, Jim. Look, I trade stocks and ETFs, but I also trade the options on the stocks and the ETFs occasionally here and there, okay? So again, and Roger does the exact same thing. Can you use it and trade it on currencies? For the gravity, you can trade currencies or anything. Not the volume spike, though, okay? And Cheryl, let me just get to your question here too. Yeah, okay, that was your question. Yes, yes. Your question was, can you trade options with these strategies? And the answer is absolutely yes. We trade the options as well here. Okay. Let's see. I have time for another question before I let you go. Okay, we're running a little over an hour now, so I want to wrap this up. So now a few people now are asking about the guarantee. So let me address it again. Again, it's really simple. Okay. Within the first 30 days, if you don't come out a net winner after 5 trades, we'll give you 100% money back. Real simple and straightforward, and I think very, very fair. So again, you really have everything to gain by giving it a try. I mean, Roger and I both trade these strategies, so we both know they work extremely well. And again, remember, Roger is an ex-hedge fund manager. He took 20 million to 740 million in just under 11 years. And these same strategies that he's teaching here are a reason for a lot of his success in the hedge fund. So again, I think you'd be foolish if you didn't at least give it a try and see him for yourself, because he teaches you the step-by-step on how to utilize these strategies. All right. Oh, yeah. Yeah, Robert just pointed out. Yes, Trading Concepts does have an A+ rating on the BBB. All right, thank you, Robert, for pointing that out. All right. All right, everybody. Once again, I want to thank you for taking your valuable time and joining Roger and I today. We both truly do appreciate you choosing us to listen to today, okay? And to join us today inside of the Gravity and V-Bounce Volume Spike Strategy programs, where I believe there are only about 20 some odd left. I mean, people have been just taking these left and right. So simply go to the link at the bottom of this page. Yes, good for you. Good for you. There. Okay, so we've got a little over 20 left. So be sure, get in. We'll give you immediate access so you can start using these strategies the next day or two. All right. Have a great rest of your day, and we look forward to seeing you inside where you can start trading the same strategies we use on a daily basis. And thanks again, everybody, for attending. Bye for now. And remember, if you have any questions, just let Roger and I know. Again, thanks for coming out today.